So today we got another reactions video that we're going to go through. And Chase, this is major news, especially if you're in the credit card stacking industry. This is major news. Chase is going to switch to cash flow underwriting. I wonder why. Okay, I wonder why. Maybe too many plays they ran on them. Okay, maybe their business credit card default rates are just out of this, where people are not paying back exactly what they borrowed, or they're trying to run the play because they're trying to get some, run the bag. And all this is a mess that's going on. Now, there's good and bad areas, in my opinion. Somebody that's been in this industry for some time, and I'm going to share that towards the end of the video. And but before we get started, shout out to Credit Plug, somebody that I've been watching for some time. Always had relevant information out there, but we're going to watch this video, react to it, and also follow Mr. Credit Plug out there. His channel is showing the video right here. So without further ado, let's go ahead and get started. Let's go ahead and get this video going.
Is absolutely cooked. This article came out yesterday. JP Morgan Chase to adopt cash flow underwriting. JP Morgan Chase will use cash flow underwriting. The New York bank, which has about 80 million customers and $18 billion technology budget, will soon deploy Nova Credit's Cash Atlas software, automates cash flow based underwriting. The software lets banks evaluate a potential borrower's creditworthiness by analyzing how that person has been managing the money in their bank accounts.
So what I want to share here before we proceed is the reason behind this is the value of FICO scores has really been, as far as them being a worthy source to evaluate risk, is pretty much non-existent. And the reason why is how easily manipulated FICO score can be. And given the fact that the purpose of FICO scores is to evaluate risk, you can be poor and homeless and have like a 700 FICO score within a couple of days. And it used to be even easier before the change with the authorized user accounts, where you can be poor and homeless and have collections and go through credit repair and put a bunch of AU accounts and have a stellar FICO score within a few months. That's not really a good way and a trusted source for lenders to evaluate risk. They see clearly the results of them doing this with the default rates going up, And there's a few articles we're going to go through here as we go through this video, with Chase, private credit promising, private credit promising, being problematic, a few other different things that we're going to cover. But let's go ahead and proceed on with this video. But this was, especially when I started seeing everybody and their mom offering credit card stacking everywhere, I knew this was possibly was going to happen, even as I shared with my last video, as far as lenders collaborating and communicating with each other, knowing that there's other application being submitted. That one trick that was one of the things that made credit card stacking, beneficial, as far as, you can manage the inquiries and see, send it over here with just this lender only pulls this lender. That really doesn't really exist anymore. Maybe from like a credit union standpoint, but most of the major lenders have updated to a way that they can properly mitigate risk much better by sharing information amongst each other. Next, they're going to move into this cash flow type of underwriting. American Express already did this. And I have reasons to believe that American Express did this after their purchase of Cabbage. If you don't recall, American Express did purchase Cabbage. This happened in 2020. American and Cabbage offered revenue-based type of products. That's what Cabbage does. Very similar to like MCA, but it's not kind of an MCA. It was really a cash flow focused type of line of credit. Why am I bringing up American Express in the same conversation? The reason I'm bringing up American Express is due to the fact that if you submit an American Express application right now, you will notice that they require for you to upload your bank statements, or they require for you to connect your bank account. They've been doing this for a while. And sometimes you can forego not doing that, but all you're going to get is like a $2,000 approval. I have had people that have a relationship with American Express get an American Express business card without having to provide any bank information. But most people generally that do not have a relationship with American Express started requiring bank statements. Again, focusing on cash flow type of underwriting, especially with borrowers that don't have an American Express relationship. American Express really tries to have their own type of credit profile. You will notice as well when you submit with American Express, if you currently do have an American Express account, they don't pull inquiry. And once you submit with American Express, you can submit with multiple different American Express credit lines with one inquiry that was pulled. But anyway, that's the reason I bring to this conversation, to the fact that they already did it, and maybe Chase is looking at what they did and is like, man, we got to step away from this credit card stacking, man. When people start to talk about us, how they can run the bag and get this from Chase, same thing that happened with Navy, stuff like this ruins this industry, because these are really great products. Barrett, let's move on here.
Placing or augmenting traditional criteria like FICO scores in credit bureau reports. Cash Atlas also can be used to monitor for signs of trouble or an opportunity to upgrade a product. Now, what exactly does this mean? This means that a lot of these credit hacks like authorized users, trade lines, even credit repair might soon become obsolete or less effective because now you have cash.
And as I mentioned earlier, authorized users was basically already obsolete. There's lenders, and there's two things. Lenders started noticing if a file is heavily supported by authorized users, they just basically didn't approve that file. FICO also updated their FICO scoring algorithm. So lenders could choose to use an updated FICO scoring algorithm that did not take into account those authorized users. People started moving into getting these fake, literally completely fake primaries that they buy, that they get reported on their credit report as if they had a sense of, account history of paid off loan or paid off credit card or something like that. But they were fake, not authorized user, completely. I don't even know how people are doing this. So again, this pushes the fact how inaccurate, misleading from a lender's perspective the FICO score and the credit reports can be. And they're trying to figure out what is the best way to really evaluate risk now, if these credit report companies have basically ruined this for us.
Cash flow based underwriting, this is going to look at banking activity. I've talked about this for years, how the traditional underwriting systems are changing. In the past, a lot of institutions have utilized credit scores. Credit scores are backwards looking. There could be a customer that might have current financial trouble, but if you're looking at their credit, which shows their past performance, that might not let underwriters and banks know what their current financial position is. So they could have lost a job, their income could have went down. So this is a more accurate depiction of current financial status. Chase is committed to being the bank for all, and tools like Cash Atlas and Credit Passport will help this mission by giving a more comprehensive view into each individual and their credit needs. With this new data source, we can better assess the credit risk, make more informed lending decisions, and approve customers with right-sized lines of credit. Cash Atlas Cash Flow Analytics aims to paint a picture of a consumer's financial health through trended data on income, expenses, and assets. Other vendors like Prism Data, Experian, and Plaid also provide cash flow analytics to banks to help with credit decision. Now, I was actually on a call last fall with Plaid and Prism Data, where they were basically saying by around 2030, nearly 80% of all U.S. financial institutions will have some form of cash flow based underwriting integrated in their underwriting processes. So basically what that means is that they want to know how much money you actually have flowing through your accounts. The whole point of cash flow based underwriting is to have better risk assessment. As I was saying, credit is backwards looking. It's past performance. It's not current performance. Banks are starting to care less about what you did in the past and more about what you're doing right now. I know a lot of people rely on.
That's a really good point to bring up. Credit is based off past previous performance, and banks care a lot more based on what you do right now. If you're seeing how society moves right now, it's completely super fast. 3 months is almost, from a time standpoint, it's a long time. And to judge your, judge your financing based on previous history, it's nice to judge behavior, but as far as credit worthiness, with how credit profiles can be manipulated, is definitely not the best way for them to evaluate risk. So from a lender's perspective, I definitely do understand. From a broker standpoint, especially if you're a true business loan broker, this is a great thing. This explains that if you don't understand the three paths of lending, you're not going to be able to survive. This is going to eliminate these fake business loan brokers that are out there in this industry that really don't understand exactly what is required in order for you to get funding for borrowers. Now, are there going to be credit-based type of products out there? I think so. I think that you can 100% eliminate that. But Chase, given who they are, how big they are in this industry, how much of a hit they're taking with this credit-based type of product, they had to do something. Especially in this current climate that we're currently in, they definitely had to do something. Especially with how many people are using them, literally using and abusing them, I should say, as far as for people to get these credit cards from Chase and then purchase into some type of coaching program or purchase into some type of Amazon, get rich quick scheme or this or pay for this coaching. And people are just not making the returns that they were sold on these high ticket items. This is one of the big factors that people are not talking about here. So Chase is going to make this move, yes, but they will be out there. Other companies that still have a credit-based type of product. Reason why is banks knew that the income that was being submitted on these applications are all stated. Banks do know that they can verify income. Come on, this is Chase. Somebody that does mortgages, they do all different, car loans, all different type of stuff. They have the tools in place in order to verify this income that is being put in these applications. But lenders have to have a variety of different products to serve all different types of borrowers. There are borrowers that do not technically make an income, but are wealthy. People that are living off of trust plans or, whatever it is. I'm giving you different examples of different types of borrowers. Just like in the real estate industry, you can't just have a full doc type of product. You have to have a light doc type of product to be able to cater to some of these borrowers that, maybe are or maybe have some creative accounting. That they take a lot of losses in their tax returns, but technically they make money, but they maybe don't make money on paper. There's all different types of borrowers out there in the marketplace. But the point is, Chase must make this move because of the abuse, number one. That is because of the defaults. Number two, these credit cards, after the 0%, 12 months of 0% of Chase offers, they go up to like 25%, sometimes even 30%. And majority, this is the main thing. The majority of people getting these cards now are getting it from people that are not knowledgeable enough about what they're getting stuff for, that they're getting scammed and paid. Somebody's getting sold a coaching program for 25 grand and being told that, hey, you don't have to worry about it. We'll get you this Chase card and we'll charge you 10% for getting that financing. And then you have to pay the 25 grand to this coaching program. And this coaching program is going to make you this much money. And the fault being maybe the consumer not understanding and not executing on some of these programs, because some of those programs are great. I offer a coaching program as well that I teach people how to become a business loan broker. And a lot of it has to do with execution. Irregardless, Chase is losing a lot of money. People that scammers that are talking about the Chase play on social media, you guys have all seen it. But mainly, this is great for us in the business lending industry, in my opinion. That if you're not well versed in all the different products that are available out there, if you're not well versed in all the different lenders that are available out there and their underwriting criteria, this is where this is going to hurt you.
No doc credit funding programs to get access to credit. And most of the time it's because you don't have the current income. So if it's no docs, that means they're going to be relying on your credit. If you have a high credit score, maybe some trade lines or primary accounts, then it could appear as though you're more credit worthy than you actually are. Now, one of the main drivers behind this cash flow based underwriting push is so banks have better risk assessment. Instead of just relying on what you did in the past, they can see what's going on right now. Traditional loan underwriting systems rely heavily on FICO scores and a few other criteria like debt to income. These tend to decline or offer only high-priced credit to young people, immigrants, and people who haven't borrowed in the past. And people who have had temporary setbacks, cash flow underwriting is not a new concept, but it is gaining momentum. Traditional credit evaluation.
And I'm going to say this. I'm going to call this out right now. The FICO credit bureaus are going to develop a FICO scoring algorithm a cash flow based FICO scoring algorithm, which I don't know how they're going to be able to do that, because the main thing when it comes to Fair Credit Reporting Act and the way the FICO score is calculated is it does not take into account income. So it doesn't put people in a certain bracket, if you understand what I'm saying. It doesn't discriminate as far as, who it grants funding to. So this is going to be challenging, but I know the credit bureaus are just not going to lose how much business they've made from this industry. They're going to develop some type of thing, some type of product that does help the lenders evaluate based on the cash flow type of underwriting that they want to use now, because they do see the lack of value with the credit bureaus, and the credit repair industry has diminished the value of the data being held by these credit bureaus. So
methods, while historically reliable, struggle to capture the complete financial picture of modern customers. A survey of 150 U.S. consumer lenders found that 58% are less confident about making consumer lending decisions based on traditional credit files
Wow.
and scores than they were a year ago. Credit restoration, credit repair, where items could get removed off the credit file. So you can have someone who defaulted on all their loans and credit cards, get these items taken off, get a bunch of new accounts, authorized users added to their account. And now all of a sudden they went from a 500 credit score to a 750 or 800 credit score. That doesn't necessarily mean that their risk assessment has changed. So this is actually a reason why lenders are pushing now for cash flow underwriting. They're aware that credit scores can be manipulated. Another big reason behind this is because you have a lot of these no-doc loan programs, which are seeing high defaults. And Chase, being the largest bank, recently started to cut back on their no-doc credit cards. So a lot of you guys have probably seen, oh, run the Chase play, or you get 75,000 from Chase. I can tell you, I've seen a lot of these credit reports where people got these business credit cards, 75,000, 50, 60,000, defaulted on those in less than a year, and then got those accounts removed off their credit reports. Banks really want to see.
I have a reason to believe also that this is the reason why GM moved away from Goldman Sachs underwriting their business credit card program. And this is why Goldman Sachs generally stayed in the investment side, and they recently were trying to tap into the consumer side of the market, and they offered a personal loan, and then they eventually partnered with GM to offer that business credit card. It was the easiest credit card to get. I made a ton of money getting that business credit card because you got instant approval. They really didn't even request anything. I think they eventually added an extra layer and they started using the FICO SBSS score because they did not approve anybody that did not have any history beyond 2 years. But eventually they just ended that relationship. Barclays has been in business for years offering business credit cards. They definitely have a much better, tighter grip on evaluating risk than somebody who used to be an investment bank, Goldman Sachs. Then now they just simply are, they're trying to tap into the consumer end of things. But that's just my little theory as to why I believe that Goldman Sachs decided to end their relationship with, what is it? What do you call it? With GM decided to end their relationship with Goldman Sachs and decided to move on with Barclays.
A more accurate depiction of your current financial situation. Now, what better way to understand your current financial situation is to see how much money is actually in your bank account. You can manipulate credit scores, but you can't manipulate that bank balance.
Absolutely.
A study published in June found that cash flow data can help.
And just for anybody here thinking that you'll be able to manipulate that data as far as, your bank data, maybe get a large deposit before you apply for the loan, because you're going to start seeing people try to run the play, as they call it, with that format. I'm pretty sure they're going to start requiring seasoning requirements. They're going to be looking at the bank, basically historical history, is what they're going to be looking for. So it's not one of those things where they're just looking at what they current deposit, more so they're historical and where the money's coming from.
Lenders underwrite small businesses more accurately, particularly when evaluating early stage companies and financially constrained entrepreneurs. The analysis found that cash flow variables derived from bank data provided a stronger and more accurate basis for predicting loan performance than the business owner's personal credit scores alone, especially for businesses that are relatively new or have owners with low credit scores. The time frame of bank account data, also known as the look-back window, is configurable and can range from 3 to 24 months. The mindset behind traditional credit decisions and the basic idea behind the FICO score is that the best way to predict whether a consumer will be able to repay a loan is to look at whether they have repaid loans in the past. It's true that someone's demonstrated ability to have repaid loans in the past is important in predicting their future likelihood, but it can miss certain information disproportionately for certain population. With cash flow data, you're seeing the actual transactions and therefore to make judgments about someone's ability and capacity to manage credit in real time, as opposed to having a lagging indicator. Now, I've been telling you guys for years, back in 2020, about Plaid, cash flow based underwriting. Now you have a lot of other fintechs now. They're looking at payroll data. They're looking at tax information. And so while credit scores have traditionally been used to assess risk, banks understand that there are flaws in the FICO system. There are a lot of defaults across the credit spectrum, not just people with low credit scores, but even people with these inflated 750, 780, 800 credit scores. Because as you know, a lot of these no-doc programs people will qualify based on a high credit score, but since they're not providing any financial data as far as their income, and banks are now seeing a lot of defaults there, they're wondering, okay, does this 750 or 800 credit score really mean anything if we're not also verifying how much money they have to service that debt? A lot of these no-doc programs.
I would say this: is there's two things that the lenders really care about. They care about how the heck you're going to pay this back, and what the heck is going to happen if you don't pay it back. To make that make sense, we speak here about the 3 bets in lending and 3 ways in how you can get funding for your business. It's going to be a put in the description how you can download that free book. It gives you an understanding of the 3 ways on how you can get funding for your business. So let me make this make sense. With asset-based funding, going back with that analogy, how the heck you're going to pay it back and what the heck is going to happen if you don't pay it back. For asset-based funding, it's very clear. If you don't pay back your mortgage, they come take the house. If you don't come pay back the car, they come repossess the car. So the risk is there, and they assess. The fear is there for the consumer or the business owner that they don't want their life to change by having that specific item repossessed, that asset that was collateralized. Now, from the revenue standpoint, it's somewhat there as well. Not somewhat, it is there. There's just the added stuff that the lender has to do, because usually when a lender lends you money based on the business revenue, they can file a lien or file an option to file a lien against the business. So if you default, they're able to, they can take you to court and garnish the business revenue or take some extra measures. Now, the credit side of things, the fear as it pertains to what the heck is going to happen if you don't pay back was to go ahead and report a derogatory on the borrower's credit report. And most people that were supposed to get qualified for such credit lines, $25, $50, or $100,000, were people with excellent credit that value their credit score. But now you got all these scammy hood rats that trying to run the play, and they don't really care about their credit. And they're so scammish that they know how to remove the directories, come back again. And there's just so much information that is out there that, even myself, I'm guilty of teaching some of these tactics that I have taught people to help people, not to get it to that point where we are now. But the point is, lenders care about 2 things: how the heck are you going to pay it back, and what the heck is going to happen if you don't pay it back. As long as you can justify these 2 things, you always get qualified for whatever you're trying to borrow. The issue comes in now with Chase. How the heck are you going to pay it back? They don't know. What the heck is going to happen if you don't pay it back? These people don't really value these credit profiles anyway, because they're not even making their first payment. It's crazy what's going on out here.
Programs are going to go away. Chase Bank, being the largest bank in the United States, is making this first big push, and a lot of other smaller banks are going to follow right behind them with integrating cash flow based underwriting. Cash flow based underwriting is going to reduce the risk for a lot of lenders. Just because you have a high credit score doesn't really mean that you have the ability to repay if you don't have any income coming in. You could be unemployed with an 800 credit score. On the other hand, you could also have a 550 credit score and generate a lot of income. I've seen that a lot, where you might have business owners, they're generating, a lot of money, but they can't get traditional credit products because their credit score is too low because of a collection from 5 or 6 years ago. Or now they have a derogatory item, and despite having the income, they can't qualify based off of credit. So I think that's going to open more opportunities for those situations. But a lot of people out here who don't have verifiable income, is going to be a real struggle. Even if you have authorized user trade lines, primaries, soon that's not even going to matter, because they're going to say, look, we don't care about your FICO score. Show me how much money you have coming in and out of your checking account. Now, cash flow based underwriting is something I think also is being pushed, because we're seeing record consumer debt, record defaults, where a lot of those defaults are based off of credit score decisions. And you have a record amount of fraud. You have a lot of people trying to run the play, running off on these banks, and they see what's going on. They look online, they see people are able to get their credit repaired, add trade lines, add primaries, and then go run it up at the banks and run off. I actually used to work with a partner where they did a soft pull only approval. And what they saw was it didn't matter what credit score people were at. You had people at the higher end of the spectrum where they would get approved based only on their credit score and then never make one payment. And so they were always wondering, why are these higher credit score applicants not even making a single payment. Cash flow based underwriting is going to mitigate all that. A lot of these plays you see, all this no doc marketing, that's going to go away real quick. Chase is going to be leading the way, and all the other banks are going to follow suit. So, no.
Anyway, we're still currently getting people approved for business credit cards, especially with Chase. I decided to pull an approval that we just received recently. This was last month. One of our clients received a $25,000 approval. We have a great relationship with Chase, so if you're interested in getting business credit cards, there's going to be a link in the description on how we can still get you funded with Chase. We do all the setup that's needed in order to make sure that your business can qualify for Chase. But this is something that I think is very so necessary, especially in this industry. For somebody that has been in the industry for some time and have seen the different changes, what's going on right now. If you get on Instagram, the business owners, this is just a warning. There's a lot of young kids out here. It's a very easy product to deliver. I've been doing this for some time. It's a very lucrative industry, but it's just too oversaturated with people. They don't know what they're doing. So I appreciate the banks taking some time and kind of tighten things up. Very similar to what the feds do with interest rates. When the market gets too crazy, people are spending money like crazy. Hey, come on, we got to slow this thing down a little bit. Do I think Chase is going to do this permanent and this is just going to be how Chase moves on forever? No, I think that, they do make a lot of money with these credit cards. And when people are in the position where they can repay them back, then they kind of open up the floodgates just a little bit. But they got to take care of these defaults. These defaults are crazy. I do and have seen people that get these business credit cards and don't make a single payment. I have seen it, people that are running the play. So it's the avatar that Chase was targeting with this specific product. Man, the wrong avatar has found out about it. If you understand what I'm saying, and that's what the problem is, and we have to stop that. So anyway, Brian Muckins channel, Penta, founder of Penta Consulting Group, where we help you start, grow, or even expand your current business, and also founder of Broker Solutions Academy, where we teach you how to become a real business loan broker, not a glorified referral partner, teaching you the 3 paths of lending, so you're not just running the play, okay? Just having a contact at a bank, and it doesn't make you a business loan broker, okay? So appreciate your time. Link in the description if you want to work together. I'll see you in our next one.